Hi friends, so let's understand what is deferred tax liability. Let's understand what is deferred tax and how it arises. Generally, the accounting rules, GAAP or IFRS, are different from the tax laws of the country. Such a difference in tax laws leads to a difference between the calculation of income tax when using the income statement figures and using the actual taxation rules. This difference results in deferred tax liability or assets. Now let's understand how deferred tax liability works. A company will have a deferred tax liability on its balance sheet if the earnings before taxes on the income statement is more than the taxable income on the tax return. These differences are temporary as the company would pay them in future. Thus, the company records it as deferred tax liability. In simple words, we can also call it a provision for future tax, but it is different from the tax provision. Let's consider an example where a vehicle is purchased by a transportation company where the sole purpose of the vehicle is transportation of goods of people. The transportation company is depreciating the vehicle in 4 years. Their claim is that they are using the vehicle extensively for transportation purpose and it is depreciated on a higher rate. The income tax rules nowhere mentions that the depreciation rate should be defined depending upon the purpose or the use of the vehicle. Let's consider that as per income tax rule, the vehicle should be depreciated within 5 years. In this case, the vehicle company is charging a higher depreciation to its books and thereby paying less tax. Whereas, as per income tax rules, the tax calculated would be on a higher side. In this case, the tax paid by the company is lower than the tax calculated by income tax rules. And so, there arises a deferred tax liability where the company has to account for the liability which the company is not paying currently but has to pay in future. Another common example of deferred tax liability is an installment sale. This is the revenue recognized when a company sells its product on credit to be paid off in equal amounts in the future. Under accounting rules, the company is allowed to recognize full income from the installment sale of general merchandise, while tax laws requires company to recognize the income when installment payments are made. This creates a temporary positive difference between the company's accounting earning and taxable income, as well as a deferred tax liability. In this case, the company will pay a less tax than what it has calculated by its books. So, the company has to recognize a deferred tax liability. Now let's understand how was deferred tax liability calculated. A company might sell a piece of furniture for $1,000 plus 20% sales tax payable in monthly installment by the customer. The customer will pay this over 2 years, that is, in first year $500 and in second year $500. In its financial records, the company will record a sale of $1,000 in the first year itself. But in its tax record, it will record $500 per year for 2 years. The deferred tax liability would be 500 into 20%, that is $100. This creates a temporary positive difference between the company's accounting earning and taxable income, leading to deferred tax liability. Now let's understand what are the reasons of direct tax liability. The primary reason is the difference in the timing in the recognition of revenue and expenses. Some expenses and revenue are there only for the income statement and not for the tax purposes. There is a difference in the carrying value of the assets on the balance sheet and for tax purpose. There is a difference in recognition of profit or loss in the income statement and tax return. Then there is a set off of the earlier year losses to the current year income for the tax purposes. Sometimes a company may choose to carry forward its profit to the next year. Such an adjustment will allow the company to lower its tax liability for the current year. It increases a DTL as the company will eventually have to pay taxes on the profit it carried forward. Thank you.